For life. Hi, Ben. Welcome to Venture with Grace.
Hi, Grace. How you doing?
Good. I was just thinking to myself, I have the most powerful man of the emerging manager market just
Yeah.
because you decide who shows up at the race conference.
Not at all. Not at all. It looks more important than it actually is, I think.
I think it's pretty important. So, okay. So for the audience who are, like who are not familiar with the race conference, let's just say I feel like from my opinion, like literally we have so many like, guests on our show, either GP or LP, everybody participate. And I was at some of the events there, like the side events, obviously. It was very like, it's a room full of like LPs, GPs, everybody like socializing. And why don't we start with like, I feel like I want the audience to learn more about the original story of the race
Mhm.
conference. And then obviously you were an investor. Well, you started your career in law and then, you were an investor at Mavron and some other firms. And why don't we talk about, what's your background story
Sure.
before, Akkadian and race conference?
Yeah. Well, the important thing is that like the Raise conference always only makes sense if you kind of know that I did start in 2007 when I left Mavron and went out on my own with Josh Becker. I did a seed fund in 2007 called
Mhm.
New Cycle Capital, and I took that. We raised institutional capital, raised $26 million
Mhm.
kind of debut fund when
Mhm.
very, very few emerging managers were doing that. Um, but 2007, but then 2008 hit, and like
Mhm.
literally my largest investor went essentially bankrupt, which
Oh
kind of
no.
bad. And then I started Akkadian in 2010, really, and we went from zero to institutional capital again, and like a whole new strategy doing this. In this case, doing direct secondaries,
Mhm.
and there just weren't a lot of people in Silicon Valley in 2000, call it 12, 13, 14, who had created two institutional funds and funds with institutional capital in two different strategies. And it was just a really rare perspective at the time. And so
Mhm.
people were coming to me, like very, very talented people,
Mhm.
going, how do I start a fund? You've done it twice.
Mhm.
Uh, and so the original Raise conference was really about tactically how, it's like if you're an operating business,
Mhm.
there's like a million, conferences about how to start a company, how to build, how to raise venture capital, all this stuff.
Mhm.
At the time, if you want to start a fund, like
Mhm.
there was nothing out there about like how to
Mhm.
do it. You know what I mean? And
Mhm.
we think about that now, and it's kind of crazy. Like there was like
Mhm.
nobody doing it back then. And
Mhm.
for Fund One, or excuse me, for Raise One,
Mhm.
it was just all about like the tactics of like,
Mhm.
how do you raise capital? How do you build a
Mhm.
brand? How do you hire people? How do you manage investors? How do you build a back office? What's
Mhm.
important in LPA? All those things. Um, and so we got amazing fund entrepreneurs, as I called them. I like sort of came out, so it was a conference for fund
Mhm.
entrepreneurs, amazing fund entrepreneurs. Like I had like Kate Mitchell from Scale and Phil
Mhm.
Black and John Callahan from True, Aaron Price from DBL, like just wonderful people who had started, sort of big investment franchises,
Mhm.
and said like, how do you do this? And
Mhm.
I know it was great, except for I was at the Golden Gate Club. It was our first time doing this. We had 140 people there. I had an empty room where I didn't have any content.
Mhm.
As anyone does conferences knows, the hardest part is like really compelling content. That's what really
Mhm.
breaks the brain. And so I just went to well, I'm gonna have 40 of my own LPs there. So like, why don't I just go to my friends who are in market
Mhm.
with C funds, and
Mhm.
like we'll put them on stage and let them pitch. It was a total filler. Well,
Mhm.
half the conference literally gets up and goes down. It's like pounding to try to get into this room to watch the GPs pitch LPs, and I'm like, oh, this is the product market fit. Like this is what people want. It turns out VCs don't really want to talk about how to read their LPA and understand the difference between tax distributions and all these sort of technical things.
Yeah.
They want to talk about raising. They want to meet people. They want to raise money. They want to meet LPs. So then we created a new goal, which was to become the place where forward-looking LPs come to
Mhm.
discover the next generation of great
Mhm.
VCs. And that's what's evolved into after 9 years. So is that place where where at this point last year we finally passed it, where most VCs go to a conference and there's 80% GPs and 20% LPs at best,
Mhm.
except for maybe the upfront conference. But the you know our goal is every year to deliver 3 LPs to
Mhm.
every GP, and we did that last year for the first time. So
Oh, I feel like last time, from the people I met, people were saying it was like 2 LPs, 1 GP, and then even the LPs are pitching the LPs. So I
yeah,
feel like it was a great turnout, seems like.
yeah, no, it was even more. It was even more. Yeah, we had even more. The ratio was even better than that. And so, but so GPs just don't even know what to do themselves because they're not used to being like a room full of LPs. Um, so that's been really fun. And now for this year, what we're focused on is not increasing the number of LPs anymore because we had to leave like 100 LPs who couldn't come because we didn't have room. But it's really increasing the quality at this point.
Mhm.
It's much harder for LPs to get in this year,
Mhm.
which I think is great for both sides of the marketplace.
For sure. Wow, it's hard for LPs to get in. I wonder, so like at the beginning, how do you even know this many LPs? I think like one of the other question I had were like, okay, so on our show, like a lot of people are saying you need to meet like 2,000 LPs to actually close a small fund, and but my like a question in the back of my mind is like, how do you even know the 2,000 LPs? Like that sounds just bizarre.
Well, I mean, so for the first is I don't. Everyone thinks I know all these LPs, and I really don't because it's like, one thing I learned early on is if you want to get anything done in this world, it's incredible what you can do if you sort of share the platform
Yeah,
with
like
other people.
crowdsource
So
basically.
I started when I started out first thing I started out was like we actually had 2 fund of funds that were like our
Mhm,
sort of co-producing partners.
mhm,
And we find that when LPs invite other LPs, because I was a secondary guy, like, I wasn't an LP. And, LPs, it's very LP led. And so now LPs just go sign up. I don't, I've met many, many LPs through this platform, but like, LPs come up who I've never heard of, they fly in from all over the world now. Um, and, I probably end up having sort of, follow up meetings one way or the other with maybe 30 new LPs every year. But
mhm,
it's not like, I know them all because it's possible. There are thousands of them in the community now.
mhm,
Right? So, but it really did just spread over the years. And last year was so amazing. And the thing was, I was just like loved seeing how
mhm,
the energy that was there for new
mhm,
managers. But, I think the truth is that if you take something and you improve it 20% every year and you've done it 9 years, it just slowly gets them better and better,
mhm,
because like, even 2 years ago, I think there was a lot of like LPs there who like, just got in because we didn't have the resources to screen them out or the
mhm,
demand to say no to everybody when they sign up early.
mhm.
But this year we do.
Wow. Okay, so how do you vet the LPs though? Like I
Mhm.
feel like if vetting GP is easy. It's
Yeah.
like, okay, not easy. It's not easy. But yeah, like I mean, I feel like the LPs are harder to vet because you can't be like, hey, can you show me your track record to go
Oh,
in?
so we don't make LPs show the track record. We do make them, we ask them a lot of questions when they sign up, and then we do have a team that has gotten better and better at ferreting out like people who really shouldn't be there. It is a huge time because it's free for LPs, right?
Mhm.
So a lot of people try, like in particular, a lot of GPs try to sneak in as LPs, which is extremely annoying to us. And they will say, they'll say, "Oh, I'm a," and there is also a truth to one other thing, which is, you know, we want a diversity of LPs because
Mhm,
having high net worth individuals, or
mhm,
small, sort of, who actually love writing checks to emerging managers is really important for Fund One,
mhm.
right?
Yeah, yeah,
And like nothing makes me feel better than like when I'm at the event and it happens 5 or 6 times every year
yeah.
where
Mhm,
somebody will literally get a check at the event, but it's like 250 or it's $500,000 check. When you're in Fund One, like just like meeting somebody and having them be like, I'm in,
yeah,
is
yeah.
amazing. It's, if anything, it's just
Exactly.
amazing
Yeah.
psychology because it's such a such a blood beating your head against the wall kind of thing to raise your first VC fund, unless you're
Mhm,
very very lucky and have some sort of amazing track record. But and so those are the best. So the hard part is sorting out like
mhm,
who's legit and who's not.
mhm.
And all I just say is like every year people sneak in, and I'm super annoyed. Like last year, some people snuck in who represented themselves as fund to funds, and they were actually there to raise money from LPs. They were just hitting people up all day, and those
Crazy.
get blacklisted, and they're not going to be invited back next year. So it is what it is.
Mm. For sure. I felt like the other question is like, okay, so how do they even like do the diligence though? Like, is that like the LP have to invest in XYZ's fund? Or is it more of like, I guess, what's the LP benchmark? Because the GP benchmark, assuming you said that this on another podcast, is like uh basically you guys would like select like from, let's say, 100 people from 700 pitches, and then they have to have like a really unique um either go-to-market strategy or like fund niche that they actually have thought through. It can be like a super networked person, yada yada yada, right? So
Yeah.
like for LPs, I guess, like what's the equivalent of like the
Yeah.
criteria?
So I mean, basically, all we can really do for LPs is like make sure they're legit, right? So, we're going to look them up on LinkedIn. I mean, obviously, if somebody's got an email address
Mhm.
from some firm that's well known, they're easily in.
Right, yeah.
Like top tier, Fairview, like
Mhm.
legit, right?
Mhm.
Um, the hard part is the sort of the high net worth individuals, and that's
Mhm.
really where we do that. And sometimes we reach out to them, and we sometimes get them on the phone and say, like, who have
Mhm.
you invested in, what have you done, particularly early on, because this year, I mean, we got, I think, 350 spots or so for
Mhm.
LPs on registration, and I think we already have 200 people signed up. So
Mhm.
this year we'll have the time to like go through and be more careful. But all you can do is kind of vet, are people legit? I think an interesting question that's kind of another side of the ball is like, we do have LPs that come that are big name LPs, or like
Mhm.
pensions and like
Mhm.
university endowments, who are really unlikely to invest in any emerging manager,
Mhm.
but everyone wants to meet them, right?
Mhm.
For someday, right? And so
Mhm.
because uh, these relationships takes so long to get new LP, typically like an
Mhm.
institutional LP, right?
Mhm.
And you got to like kill it over long periods of time. But so that's another question we have. We have a question about like, what percentage should be fund of funds, just because like,
Mhm.
the fund of funds, this is their job, right? So they're going to send
Mhm.
like 4 people, and that's how many. If we're taking out for other people, is that limiting? So we're lucky that finally, after all these years,
Mhm.
we're at the point where we can start being picky on the LP side. But that's that's new.
Mhm. I just thought it was like so impressive because you have to like continuously like build up the track record year over year. And then when it was like not like a very obvious crew, now it's like super popular. Everybody want to be a GP. It's like you suddenly have like a billion demand in this thing. But like I
Mhm.
think at the back in time to actually having this group just gather together is like a very hard thing to do, I feel like. Um, so I wonder, so like, okay, you chat about like one thing I thought were really interesting was like you mentioned on the other podcast was like uh basically you said that like a lot of the GPs that actually coming from famous brands, like they kind of underestimate how much work it goes into to start the fund. So some of the best performing fund were started by like a great operator plus great investor
Mhm.
combined, right? So like I wonder, like for the best performing fund, in your opinion, like how are they differentiated? Is that like just one person go out raise everything and then one person take care of the deal flow? How do people split up the work? And yeah, okay, I'll stop
I
there.
think it's important to say, like, I've seen all types of composition of founders
Mhm.
become successful. Like, I've seen individuals who've never, who just were great angels, solo GPs, and just super
Mhm.
connected. I've seen them be successful. I've also seen, I've also seen like, very developed firms, come through that have sort of deep theses and, very unique information
Mhm.
advantages be successful too. And but for pattern recognition definitely is that I definitely see like when you have, first of all, I just think that great operators operate businesses great. I mean, I
Mhm.
look like at a firm like NFX, which I just think like executed its
Mhm.
business very, very well. No real investors, just 4 great operators, and they really operationalized their business in a way that other VCs were just not. And
Mhm.
it's super impressive. So that sweet spot, I do really like to see, like, one great investor, one very seasoned investor with one killer operator, because I do think that tends to be like the sweetest the kind of the easiest spot.
Mhm.
I also think that that's the spot like the LPs that are interested in fund ones and funds twos are most attracted to people who've been super successful elsewhere. So an operator, like an interesting one to bring up is like Cortical Ventures, which is which is an operator and a investor, like Intel Capital, founder of Vita Robot, like and very very good operator and very 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 good, very proven venture capitalist.
Mhm.
They've done very well, and it's something that kind of a group that kind of stood out to me along those lines. But at the end of the day, like you want to have an emerging, if you want to be an emerging manager, you want to stand out because this year we're expecting like 1,000+ funds to apply. Like in that instance, where we have a limited partner selection committee, it's going to be like 70, 60 or so folks this year. What stands out in that process is people like that, and they're, whether, I think that like Pebblebed is another really interesting example. Keith Adams, had been, at Facebook, and Pam Vagata, his wife, she had been at OpenAI, amazing backgrounds. Then they added with a really, really developed angel track record that you could really like get into and see what their access was. Again, done super well, raised fund 2 in like a nanosecond. And I think of another really good example of like, hey, that's what right looks like. In that case, they'd also done a lot of ecosystem building. Like the difference between, like, I think you said it, if you're just somebody's like, I'm super connected, and you're putting up quotes from famous people, like that's mostly snoozeville for professional LPs. Like they want to, professional LPs want to see like that you're a team, that you're a team with really interesting backgrounds that give you unique access and information, and that you've built an ecosystem around your firm that you can touch and feel, not just a bunch of quotes from rich people, because like that's cheap, and you'll be amazed at how many people's decks just are like read like that. It just doesn't stand out.
Okay, speaking of decks, I want to maybe start with like the broader question, which is like fundraising process, right? So like, I feel like, one of the things that like I heard about the most is, it's kind of like a numbers game. Obviously, that's like a lot of people are saying it's, you chat with 2,000 people, you will close like a $10 million fund. But on the other hand, like it's like, do you go to the anchor LP first, or do you go to like a 5 billion people write small check first?
Again, like I've seen it both be successful. I mean, I think your life is very, very much easier if you start with a sizable anchor. But I have seen so many people, scrape together a $5 million first time fund, killed it, and then been off to the races. Either can be successful. I think you have to, people have to match, I think, the type. I mean, you have to kind of know who you are, right? Like,
Right, yeah.
So there are people,
That's deep.
and I know them, right? You have to kind of know, like, match your fundraising strategy to who you are, okay? Like, and what you like to do. Like, I do know some people that I call our scorchers fundraisers. They are, people I've had to cut off from asking me for intros because obviously I've got gazillion LPs in my LinkedIn, and then they're like, "Can you introduce me? Can you introduce me? Can you introduce me?" I'm like, no, like I just get burned out with it. Like and plus everyone's asking me that. So like in order to keep my signal like relatively high, I really have to be careful. Not that be bad with those people, but like and to them it's just I just want an introduction. But man, when you're being hit up all the time, it's exhausting. And like but there are people who has been successful and that is their model. I will talk to absolutely everyone under the sun. And they're the most persistent and they do not care and they beat the head against the wall, but that can work for them. I know other people who are just, they come at it from information first. Like I'm going to educate LPs, through multiple interactions, multiple forums, whether or not that's, both like with content marketing plus in-person events, plus just constantly like staying close to people. And by like being super educational and being really and showing you're really smart and like getting to know the LP over time, like that's just time tested, like time tested, right? And then I got other people who know just right how to create that aura of scarcity,
and
like
FOMO, basically
FOMO and like pull on strings, and then they run away, and then the LPs follow them, and like that's great too. I've also been seeing other people who are like great at somehow orchestrating what I call the LP whisper campaign, which is the secret that read this done. Like you get a bunch of like a couple LPs talking about how like to really advocate for you, you'll be unbelievable how fast LPs will follow other LPs if they respect them. So you have to be able to align, like, who are you? Like, if you're a great marketer and you know how to sort of like create the air of invincibility, do that. But if most people aren't like that, they have to just like one person at a time, get to know them, and take it from there.
I wonder, I guess, like, how would you, I'm sure like people pitch you all the time too, but I guess, like, how would you walk through the conversation if you are starting a fund today? So like, would you ask the LP for advice and then in the end for money, or would you just straight up be like, hey, I'm raising this fund, but what if people just don't take the meeting?
If I was running a fund, so let me see, if I was running a fund today, and I would build my so because I just I would start first with saying, what is going to differentiate me in this very crowded marketplace? So you have to pick an interesting space, first of all, especially if you're doing early stage. But I would start with the ecosystem building, like, because when you build that ecosystem, that investing in that is what will, it's like move slow to move fast, So let's see, I was just thinking about, so Peter Sonderling, I think, is a really good example of this.
Yeah, the data council guy.
Yeah, so he went and built Data Council, and it's an amazing conference. And any investor can look and touch that, and I'm invested in his fund, and and they can absolutely look and feel and touch that and be like, oh my gosh, look at who he's around all the time. Like, how is that not an absolutely great VC mousetrap? Another one, I'll say is Go to Market Capital. And this guy, he's created a whole network of CIOs that look that will basically agree to like seriously look at early products that are coming out. And like, what a way to differentiate yourself. He's just built a huge information advantage for himself, and like, I love that. Like, I just think it's fantastic. Like, that's a great VC mousetrap. Again, like, who are you? Like, some people are just hustlers. They can just go out and schmooze. But I do think that like the people that think about this issue the least are the people that come out of big firms, because they think that like, hey, just because I was in Andreessen or Sequoia, that's going to be enough. And some of them are amazing. Like, I'm not saying they're not amazing. I just think that they're absolutely underestimate what it takes to land new institutional LPs and how many people look like them every year.
Got it. I feel like that's super important to like actually build a community / ecosystem in a specific domain, or like based off your like subject expertise. I wonder, when it comes to like the community building people, let's say you have like a deal funnel from like a group of people, and then how do you turn that into a track record? Just because, a lot of the emerging managers, they may not have like $1 billion to like invest in these companies. And then you talk to the LP, that it's always like, okay, the chicken or egg problem. It's like, okay, you never, they're in your like deal funnel, but you didn't really invest. Like, how do I know if you can actually invest into it? So that's kind of like the problem,
for people who are like starting like that, you really do have to just start small. So, you basically, go out and say, I'm going to raise a $25 million fund. And I always say, do not wait to get to 12.5 million to get going. Like, talk to your friends and family, and at 5 million, go and invest. One of the tricks that I've seen people do, just, that's just like the reality of this, is they'll go out and they'll raise 5 million, they'll start to invest. And then what they keep doing is they just keep keeping their fund open. Because usually, and this is like the inside baseball, right? What they do is they put friendlies on their LPAC, and then like, they're going to just go out and keep fundraising, and the LPAC will just keep expending the investment time. The time is, then you have some hits, right? And then people, and I'm not advocating this, by the way, because I do think that there's a downside to this. But people will then get big markups. Then they have real things to invest in. Like, you're not investing in a blind pool anymore. Here, I've got 10 investments. We're at a 2.3 times gross MOIC. You're investing in $1. You're getting an immediate bump, right? And then they just keep going back to LPAC. I have one of my favorite emerging managers is like the master of this. And I think he's just finally closing. I think he's been fundraising for 2.5 years, 3 years to get the fund. And like, by the way, I don't care. Like, I'm his friend. Like, I'm like, yeah, just keep going. I just want you to be successful, but like now, if you have LPs that are like fund to funds, they're not going to give up their mark. Like, they're going to be like, you got big markups. They're going to be like, okay, that's it. I'm not going to get diluted by new investors. Like, get out of here. So it depends on who your limiteds are. How you can
for sure.
Excuse me.
I hope you're okay. Okay, so I wonder. Okay, so now, let's say we build up this pipeline, and then like I guess like when you started talking to LPs, I guess you mentioned like you can go for the anchor first or the smaller like checks first, but I guess like what would be most people's target fund one size that have like the highest return rate?
Oh, I don't know about the highest return rate. I will tell you that, like, if you're, I'd say that, honestly, small funds, do not be afraid of them. Like, we looked at a couple of years ago, we looked at the data. We haven't done this. I should go back and look at it again. And I wrote a piece on like, if you're looking for a 10X fund, you pretty much guaranteed you have to look under, like, it was like 80% of the 10X funds that have ever come through raise were in funds that were sub 20, 30 million, I think. I can't really remember the number. Well, when you have a 10X fund, you're going to have a good time raising money, right? Like, so honestly, like the size of the first fund is pretty much irrelevant. Like, I've seen people with $100 million funds, be successful, not successful. All that matters is that the first fund crushes it. Now, there is a problem with the first fund in that if you're taking fees out of at 2.5% out of a tiny fund, like that really, really causes a pretty deep J curve, which can be problematic. So you want to have your fund to be big enough where you can like not get so deep in the J curve that you're kind of killing yourself. But by and large, I just don't think it matters. I think ideally go out. Anybody that's typical number I see is like people going out for 50 million. It depends if you're two partners or one, but like 50 million, 2-person first time fund is kind of, for an early stage, is very typical.
Love that. So what is the J curve thing that you were talking about?
Oh, well, this is like the bane of all early investors' life. So, and it's in every VC fund. You're putting money in at cost, but you have fees and expenses.
Right.
So if you put in $10 million but charge $1 million in fees, then your market, you're underwater on your net TVPI, the total value of paid in capital. So you're gonna have a period of time where 1, 2, 3, you're going to, and then it should come out of it over time. But the challenge is you typically want to be out of your J curve by the time that you're raising your next fund. And if you're have a small fund, you can be on to the next fund pretty quick. So that could be a challenge.
Got it. So when okay, so let's say you and I start raising a fund. This is like imaginary situation. I know you have a fund, and like let's not. I don't want people to be confused, but okay, let's say you and I start raising a fund today. How long should we close our first fund? You mentioned about a guy closed 2.5 years and still raising, but is there like a common standard on like?
No, I mean, like you're supposed to close within a year, but I probably see half the funds that are successful close within a year, and half of them go past a year.
Got it.
Yeah, because the way that the incentives are pretty dramatic. Like it always gets easier to fundraise as you get closer to your target, and then everyone wants to come in last, right?
Yeah.
Like, for investors, it's just better to watch. Like the hardest part of this fundraising is like creating the sort of the reason to close early.
Yeah. So like sorry, keep going.
Yeah. So getting people to close early is the hardest part. So I'd say that like half of them get done within a year and half are past. I see.
I feel like, how do you create FOMO? Because for founders, you can get incentive as like you come in early, we give you like some sort of like a financial incentive to come in early, either it's like pro rata or like whatever. But for funds, like I don't know if there's like any kind of like FOMO creator that.
Well, I mean, I've heard of people artificially creating like, so yes, there are some ways. Obviously, the best way to create FOMO is just have lots of interest, or people are out there telling people to have lots of interest and putting deadlines in. Be like, it got to be here for this time, and telling people, hey, this company's about to be a big markup. You want to get in before that happens. Having I did hear one manager years ago telling me that he created FOMO by having a specified number of slots. He's raising like $50 million fund for each type of investor. So it'll be like, we're only going to take 2 fund of funds. We're only going to take 2 family offices. And like, that was kind of like, created some artificial scarcity. I don't know if it worked or not, but that was one thing I heard. Yeah.
Got it. Yeah. And then how frequently do you stack these conversations? Like, do you stack them in like 3 months, every single like 30 minutes will like batch? Oh, the L is there. Like, I guess, like, how do you structure the pitch? So, like, basically, I guess, like, I've heard my friends that would DM like people on their social media, follower, yada, yada, yada. So basically you DM like a bunch of social media followers, and then some people will just take the call and then they batch, let's say, the call in 3 months. Every single day, you only talk to LPs and then you close it from there. Or is this like dragging on?
Oh, man. I would say that I always ask people, especially like people who are frustrated and they're raising like their 3rd or 4th fund, what percentage of your time are you spending on fundraising? Because trust me, the people that are good at it are spending like 75% of their time fundraising and just beating their head, as many meetings as they can possibly get. And then being super organized about follow-up, which is a, challenge in its own right, when you're dealing with hundreds of investors. But, I would say that like you really got to stack as many as you possibly can at the beginning. Then there are certain people like, you just know certain LPs, especially if we talked to them before, that they're not going to be first closers. They're going to be second closers. And so them, you probably wait until you have enough evidence to marshal those conversations. But by and large, people that are good at fundraising are good at it because they spend the most time doing it. And like, that's what, it's like being a politician, right? The people that are politicians, they spend all their time fundraising. They don't spend a lot of time working on legislation, right? They're just constantly fundraising. And like, it's the same thing. Like the VC part of the job, truth be told, I know exactly what VC spend the time doing, I got some people that are on 10 boards that spend all the time with the companies, but they at least have partners that are out there fundraising all the time. They have IR people, who are doing it. That's a big thing. Like, especially again, people who lead big platforms, like they've never even talked to an LP. Like, you can be at Andreessen for years. Like all that stuff is just taken care of for you. You'll be like, never know like how to do a capital call. You never know what goes into it, Yeah.
I think that's so true. And I wonder, how do you think about like building a team for your VC firm? Like, do you see like a solo GP raise better versus, let's say, you collab with like another person that's like...
I think that by and large, I would say that that's really interesting because I think that there's pros and cons to being a solo GP. And obviously I know some, and most solo GPs are pretty happy when they get the right partner. But getting a partner is just fraught with such risk, because I've been a solo GP and I've had a partner, and I'll tell you, like, having a right partner is better than solo GP, and the worst is having the wrong partner. It's just like a marriage, like being in a happy marriage is the best, but being single is better than being in a bad marriage.
Right.
Exact same thing. It is nothing worse than having, because first of all, you're just entrenched together. Like, breaking up, like venture firm divorces, like, are just devastating. Like, you're just so intertwined, and it's incredibly easy. Like, think about like what we do. We go into these like situations like fraught with risk. There's always a good side, like why to do something, why not to do something. You look either like an idiot or a hero in hindsight. And it's very, very hard to have relationships can withstand that kind of like high risk uncertainty, and they deal with people's like careers, right? Like, and then frankly, it's like VC firms can be profitable businesses, and it's hard to get people to agree about how to handle them. And I think that having a bad partner is the worst. But I'll tell you that just like in talking to many emerging managers,
Mm-hmm.
the people with partners feel happier to me. Like, they just feel like there's a weight on your shoulder when you're a solo GP and all that rests on your shoulders. I think it just gets lonely after like a long period of time. But there's some people who've done it really well, and some people are just like, I love to be a lone wolf. And again, it's like knowing who you are. Like personally, I was not happy being a solo GP. I found it was very lonely, and I'm much happier now where I have a good partner at Akkadian. So, yeah.
I feel like one of the I hear about this from founders all the time that like people were saying, let's say the co-founder doesn't pull the same amount of weight. I'm sure like this also happened in the fund world, but like how do you think about what is the correct weight to pull? Like do people divide and conquer into different effort, or since like you're more experienced, you've seen a lot of stuff?
Well, so I would say this. Like if in my view, if you're going to be a general partner at a VC fund or any private equity fund, you have to be able to raise LP capital and you have to be able to do deals. Like if you're only a fundraiser, actually there are people who've done this successfully. They like outsource the deals to everybody else. But particularly when you're like building, that works when you get to a certain size. There are big firms that operate like that because frankly, the people that raise the money are the ones that have the power. So it's not the deal maker that has the power. Deal maker is a commodity. You can find a lot of people who can do deals. A lot of people can just have networks of founders, but it's raising LP money that is like what is valuable. And that's what, that's the lifeblood of VC fund, right? So, the way I've always looked at it, like if you're going to have a managing director stake, as a as a real general partner, because a lot of people have the title partner, but they're not really partners. The question is, do you own what percentage of the management company do you own? That is what determines if you're a partner or not. If you don't own any of the management company, you have no say in the management company, you're not really a partner. And that's, everyone knows that, it's kind of obvious. But if you're going to like give away a slice of general partnership to a new partner, like that person's got to be able to raise money and they got to be able to do deals. And if you can't do, if you're a terrible fundraiser, like, it's just, you're not gonna be able to be a full general partner. I don't think so.
I feel you. I think that's so important. Like just because I feel like most of the founders, they only see VCs deploying money, but like in the back end, like everybody fundraise. I wonder when you were thinking about I guess like portfolio construction, let's say the first fund, would you say you would go for the index approach, just deploy a small amount into, let's call it 40 companies, or like would you be the concentrated approach, saving something for follow-on stuff?
Well, so there's a lot to argue about that. So my preference is, as an investor in early stage, is to have a group of fund managers that all have about 20 to 30 companies in each portfolio.
Right.
I have a bunch of them so that my portfolio is big enough to get, according to power law. Both can, again, like I know it's like both can work. Like and people argue about it to no ends. I think that the larger your portfolio is, and if your deal sourcing is good, the problem it's like more likelihood you're going to have that big winner. It's going to be a smaller percentage of your funds, so it's not going to move it as much. The really great funds are pretty concentrated. The funds that I've seen that are 30x funds, they had like one or two winners in a portfolio of 20, and they just crushed it. Like those are going to be your best performing funds. So I think overall you have to have a strategy. What I would not do on seed, at least with seed investing, is just do one or two managers. You have to make sure you have enough coverage to sort of deal with the power law. But the portfolio construction, like, I've done a lot of talks about portfolio construction. I think the thing that we see is that very few early stage managers really have a really disciplined sense of portfolio construction. Like, there are people that have amazing, like, amazing, like just very strict rules about how much ownership they get at what level, what their pre-money valuations, and then you just worry about like, is there some negative selection bias there because you're passing on hot deals, but I think that it gives an LP a lot of comfort because they're like, what can the LP diligence in an early stage fund? They can be like, show me your fund construction model. Like, what do you, and we care a lot about creating early stage exposure and what the pre-money valuation is on our entire portfolio. Care a lot about that, and that's something we think about a lot. So I'll see managers I love, but when their average pre-money in their portfolio is 90 million, that's not early stage. That's like Series A, B kind of stuff. But on the Akkadian side, I'll tell you that we just learned over the years that like you want concentration. You want to own as much of your winners as you possibly can, and that's very much what we're about there, because that's what pay the bills. It's not raise. Everyone knows me for raise, but my secondary fund is what pays the bills.
Wait, let's talk about Akkadians. So I wonder, how do you okay, so why don't we give the audience a little bit of background? I know that you guys are growth stage secondary funds. Correct me if I'm wrong.
That's good.
But why don't we talk about how did you started that fund, and then what are things that you guys are looking for now?
Yeah. So I started Akkadian back in 2010, and really about doing small direct secondaries between rounds, because nobody was doing it on an institutional basis that was small. I think back then, even industry ventures who had pioneered the whole market, their minimum was, I think, about 4 million in 2010 or 11. And I was picking up like $500,000 pieces, like really small, but it worked really well. Fund 1, Fund 2 did great. It was a great time, well timed. And now we're on Fund 6. We're currently investing out of a $300 million vehicle, and currently deploying. Average revenue, and we sort of everyone asks, how does you sort of fit into this? We do a lot of work with emerging managers on their growth rounds, where we partner with emerging managers who have got really great access, back them in the sold company SPV, and then once we're in, then we can sort of build up a secondary business in the best companies, and everyone wins in that scenario, right? And so that's it's been a lot. That's a lot of those deals have been sourced from raise. That's been good. So, but revenue, average revenue is about 100 million. Average growth is about call it 35-40%. Value, we're in at really reasonable valuations is what we're looking for. So it's much more of a value orientation than anything else. So quite different than your early stage, and very concentrated. It's like 15. It'll end up being 15 names at the end of the day for $300 million.
I wonder, so how do you pick deals? I feel like the thing about secondary is okay, if they're the hottest companies, they must be super oversubscribed no matter what stage they are. But how do you kind of evaluate which one to go into? Obviously, you guys have some really great ones in the portfolio, like Masterclass, Line, and a bunch of stuff. Yeah.
But I would say that we're very focused on finding businesses that are, for Fund 6, kind of number one in their space, that are we're like a growth at a reasonable price. So your super high, value AI deal that's just trading on momentum, particularly when people are buying and selling the stock with no information, that's just really hard for us to do, and we really can't compete with that. And that's not what I sold my investors. We're in sort of the 4 and 5 times revenue kind of multiples, and we're value guys, and so you're looking for businesses that are undervalued, that are hey, look, these aren't going to be the highest profile businesses, but they're going to be have real chances to be public companies. They're growing really well. They have good unit economics. They're fully funded. I mean, one of the interesting things is after 2021, we were so many people had raised so much money in 2021 that we were only want to invest in things that don't need to raise any more money, because we don't want to depend on the capital markets. And that's been a really good decision. Because the companies, of all the companies we've invested in, I think we've 12 material names in Fund 6. We've only had one round of capital be raised. Now that's great, because the companies are going on, but also usually in previous times, that's where you get your markups, this new capital raising. So it doesn't feel so exciting in the interim sometimes, but also, the companies are growing, and they're adding value, and they're getting bigger, and I think our average revenue now is about 100 million. So
Mhm.
it's a nice place to be. These are real businesses.
For sure. I'm like taking notes. I wonder, okay, so I got like a lot of DMs of people creating these like SPVs of the famous companies
Mhm.
called like tier one AI company in the world, or like Elon Musk's certain businesses,
Mhm.
etc. So like, are those like investment that you would pass on just because they're like
Yeah,
overhyped,
yeah,
or
because because those people, the people that are doing those kind of like SPVs and big names, like
Mhm,
they're trading on the fact that there's a brand and that somehow that they figured out a way to get access to it.
mhm,
It's it's fine. I think that, but the problem usually is like access to information. Like there's a difference
mhm,
between being an individual running an SPV,
mhm,
and the barriers for that are really low.
mhm,
It's just like, hey, look, is there some way that you have access to a particular round? And when rounds are in the billions, there's usually a lot of pathways to get access
mhm,
to it. um and when you have a big brand, so it's kind of like a very low barrier to enter business, and that's why there's so many people to do it. It's very different than raising like blind pool institutional capital.
mhm,
Very, very different. Like, and we by and large, like, I could argue we made some mistakes passing on those situations, but it was always about like, our investors paying us to like invest in somebody else's SPV. I don't
mhm,
think so. Like, so it's very hard for us to do that,
mhm,
which is like too bad in some ways, because there have been some, and we looked at that first Anthropic SPV and passed on
mhm. Yeah.
mistake. You know,
Mhm,
not only mistake, but very hard to justify doing. And so, because like you said, these SPVs are offered to everyone. We're not adding a ton of value by like
mhm,
putting our investors' money into an SPV that anyone can
mhm.
get access to. So that's kind of where that is.
So what's kind of like I mean, obviously you have like the funnel from the emerging manager
Mhm.
world. Like, um, I heard from other GPs that like every emerging manager have one deal. That's amazing.
Yeah,
So, how do you
true.
like,
And that's
yeah,
about working with those. I love working with those emerging managers on those deals. Like that's really fun. Because
um,
if you raise a $20 million fund, but you have the ability to get a 10 or $20 million allocation in a Series B or C,
mhm,
you know that's hard for them to access. Like
mhm,
they just don't have the relationships to have those kind of
mhm.
checks, to get those kind of checks.
Right.
Um, so there could be a real win-win there.
Mhm,
And that's also, I think, we're going to start looking at for Raise, is like facilitating more of those conversations
mhm,
between those emerging managers and the later stage capital, because
mhm,
you got so many family offices that want to do VC themselves and
mhm,
don't want to invest in funds.
mhm,
And so you got to kind of adapt yourself to like where the world's going.
mhm,
And there's a real opportunity there to like have, hey, look, 1,000 emerging managers came through. Like, let's go through and take some of the best deals and show them to LPs that want to have a clean way to look at things
mhm.
directly. I think it's pretty cool. So we're going to work on that.
For sure. I wonder when you're getting information about these deals, like, do you just directly ask for intro to, let's say, the founding team of these secondaries, or like, are they from like a certain, like, it's like GP selling their Parada to like other people, or like how do you
Mhm.
acquire the information about the company? Because I feel like,
Yeah, no. So I mean, look, it always starts with this. Like deals can come. This is like a VC fund. Like
right.
we have passive deal flow where people think
Mhm,
bring us things. We have proactive deal flow where we sort of try to go out and sell it into
mhm,
situations. Um, and then of course we have this emerging manager program we do. So you're always like having a multifaceted deal flow generation. Now,
right.
in secondaries, the
Mhm,
best relationships, like we love being the first secondary, the
mhm,
first outside secondary buyer.
mhm,
Uh, we love getting the market going.
mhm,
That takes more risk, right? But it's also like when it works, it just works really, really well.
mhm,
And in that instance, like a lot of it, like it starts with because somebody has a problem. Like so, a lot of deals, a lawyer will come and say, "Hey, look, they want to let go of the founder, but they want to facilitate some sort of liquidity to make this nice."
mhm,
Or the founder needs to replace his buddy who's the head of sales,
mhm.
and has been there since the beginning, but the board wants to up level that position. The CEO's like, the guy needs $3 million for an option exercise loan,
Mhm,
exercise like his founding shares, because now the company's, and he wants to be nice. And so most secondary conversations, the best ones start around that conversation. You know, I mean, like, you know, there are tenders, which are organized processes where you sort of like just come in just like a new investor. We don't love those. It's super efficient, right? Like, you know, you're just buying at the same price everyone else is. Hard to get value there. And the hotter the company, the higher the price, you know. So that can be really difficult. But by and large, you know, when you think about starting secondary markets, you know, it starts because there's a problem on the cap table that needs to be solved. And like, once you can develop that relationship, you come in as a problem solver. And I think like most of our best deals have come like where one CFO has kind of recommended us to another CFO. And that's why my partner is Mike Dinsdale. You know, he was originally CFO at DocuSign, where I was the biggest secondary buyer for years. And, you know, he facilitated that and we became friends. And then he saw kind of the value of being able to do 60, 70 transactions at a company. That's where we came in and did that. So
for sure. What's the typical check size that you guys are shooting for? And then what does that kind of look like for secondary as portfolio construction? Just because I feel like each company is valued super differently, different sector, ownership target, or like even the opportunity to invest, right? Like it's kind of case by case.
Well, I mean, I think you have to so we learned from earlier funds that having too many positions was not great. You know, so we really concentrated it down to a smaller number of positions in this fund. And we are going to own a lot of our best companies. And so that is the model. Like that is the model here. And, you know, we are quite, you know, I think we feel good about the fact that like what's cool about secondaries versus primary investing is like a lot of times we'll come in and start with like maybe a $3 to $7 million initial investment. I could argue that we probably should have been a little smaller, maybe, but and then we're going to watch and like where we see like really good traction, really good performance. Then we're going to try to kind of like scale up as much as we can on the secondary side until the price kind of gets away from us. So in our best names, like, you know, our largest investment started out as a $12 million SPV, which is big for us, but we really like the business. It was split between two funds. And, you know, and then we bought another 50 million in the secondary markets over a period of time. Super highly concentrated in that name at this point. You know, every deal we go in, we have to see a pathway to get into 20 million because we want to concentrate. And that means we have to pass sometimes. We're like, you know, we're solving a one-off problem, but the company doesn't want to do any other secondaries. We're like, well, you know, this is not going to do it for us. We do all the work. Like best position, and you know, because if you think about it, if you're a primary investor, you're kind of diluted each time. You get your pro rata, but you're still diluted. You know, versus like we can really increase our ownership over time by doing lots of little secondaries. So, you know, we'll pick up $50,000 piece if the price is right. So we do all of our own transactions internally. We have our own general counsel. We don't have to deal with outside counsel. We do it all ourselves. Yeah,
for sure. Hi, I love my Twitter followers. Honestly, I cannot even log on to Twitter like this week for some reason. But hi, Scamdy. So like this is my like longtime audience. I feel like he show up every day or she show up every day. Yeah. Hi. So okay, I have a question on like, you know, how does the secondary kind of work? Because I think in so I mean like when I was like doing venture investing in China, like so people would like send like a NDA, you have to sign, and then they send you all the data, Excel sheet, yada yada yada. But or like they can facilitate like the let's say customer introduction or something if your check size is big, right? Like, but for let's say like an angel investor or like just like everything else, like I think like the founders don't share as much information. Just they feel like, oh, the check size is so small, like, you know, they just like kind of like flake on you on a lot of stuff. And how do you think about like acquiring these like super detailed information about a company just because later stage is harder, it's more stuff going on, and like
well, I think it's important, obviously when we're coming to a company, we're talking about it, building a relationship that could be 20, 30, 40, $50 million, right? So while we may start small, and we always make it very clear, like, hey, if the company doesn't want to share information, there's not much we can do. I mean, like the information rub is probably a bigger problem. And it's a problem for the seller because like in your typical scenario, the seller is like an early employee or an early seed investor or an angel investor. and they can't get the company's attention. The company doesn't care.
Mhm.
And like, I've had just like that. It happens just constantly. Right. And the bigger the company gets, like the more successful it is, the more obvious it is, like the less likely you're gonna get information. I mean, like I was a very early investor in Palantir, and then we were getting lots of information in the early days, and then they cut off information. And I was like, well, I don't know anything now, so like I'm just gonna get out of this because like I have no idea what's going on. We did fine on the investment, but it took a number of years.
So like let's say if an early employee trying to sell very small portion of their share of their company, I guess like what's your advice for them? Let's say so and so is an early employee of this hot. Actually, I feel like the hot company, like nobody have any problem, right? Like so it's always like the kind of mid company, like they're like very successful the bit from the business angle, but the commercial value slash like the marketing value is like not that strong as like SpaceX. How do you advise these founders to sell their secondary? And
well, so
like
the easiest sale in that situation, like you really, you really want to find somebody on the cap table who is interested in acquiring more. That's always the easiest sell, right? Now, a lot of times, many institutional investors on cap tables don't have an interest in common shares, and like that's why I kind of got to go outside to find other buyers for common oftentimes. But it's always going to be easiest. I mean, I just asked this question yesterday. There's like 20,000 venture-backed businesses. I don't know the number off the top of my head, but it's like maybe there's a secondary interest in 300 or 400 of them. I mean, in terms of like outside secondary interest. We have sold, when we have sold in the secondary market, it's almost always been to a insider who wants to increase their ownership. In that case, you just got to make sure like you put yourself in front of them and be proactive, right? And like, hey, look, if you ever want to buy these shares, like just contact me. I'd be interested in taking some money off the table. Those are the best deals. If you're going to go outside and try to market a deal, you have to get the company, like you're going to just do so much better if you get the company to agree to some information sharing. That usually is going to happen best if after a transaction, let's say there has been no secondary component as part of a primary deal, but there's a data room. At that point, you reach out to the CFO and say, hey, you already have a data room. Like, who didn't get in the deal that wanted more ownership? Like, I will sell at this price. Like, can I just help me with that? And then in certain instances, if the company's open to it, then you say, hey, look, here's a list of 10 secondary buyers. Can I go pitch them, show them the data room, take it upon yourself? That works too. And sometimes you can get a broker. Like, we work with some very, very good brokers who really know what family offices want, who are coming in with really nice checks. And then if you show up with like, hey, I've got this great group, they're from this and such fortune and relevant business to you, then all of a sudden the company can be like, oh yeah, we'd love to have them in the cap table. So that can be another way to do it too. So you can you can gin up the conversation with limited information. Like, hey, look, I'm going to give you some basics that I know, but if you're really, really interested, you've done a lot of work, then I'll introduce you to the company. We see if that goes.
Amazing. Okay, I want to be mindful of time. I have a
go.
Yeah. Okay. Do you have a minute for like a 10-second fire round?
Yeah. Go ahead.
Okay. What's your favorite book?
Short History of Nearly Everything by Bill Bryson.
Who made the biggest impact in your career?
Oh man, who made the biggest impact in my career? I'd say a guy named Andy Rappaport from August Capital who got me to leave Mavron and go out on my own for the first time.
Who will you invite to your dinner party?
Who will I invite to a dinner party? Who invite to a dinner party? I really love eating with Aaron Price. I just think he's the most fun guy to talk to.
Where can we find you outside of work?
Oh, walk around Hayes Valley.
I love Hayes Valley. Okay. Thank you so much, Ben, for coming on the show. I know you have an important meeting to get to. Thank you again.
Awesome.
You're awesome.
Great to see you. Thanks. Bye-bye.
Thank you. Bye.